Welcome back. Investors continue to track very closely the path forward for central banks around the world. It's a dominant theme, and certainly investors in North America are resetting their expectations on news that was delivered about 34 minutes ago. Jobs reports on both sides of the Canada-U.S. border. Earl Davis is our next guest. He's head of fixed income and money markets at BMO Global Asset Management. Earl, thanks for coming in.
Good morning.
So what's your take on these U.S. jobs numbers in particular? Much stronger than expected.
Yeah, much stronger than expected, and basically thinks it's a sign of the unleashing of the animal spirits in the U.S. You know, with the Trump administration coming in, from a business perspective, you're seeing small and medium-sized businesses now looking to hire because there's more clarity on regulation. There's less costs on regulation. So you're seeing this as a confirmation of the animal spirits in the U.S. coming out.
In other words, you're saying employers are optimistic about the economic future and they're hiring as a consequence. Is that hiring and expanding?
Exactly. And we started talking about animal spirits on our team after we saw the PMI numbers in the U.S. earlier in the week. Higher inflation, higher expected services, higher whatnot. And this is a confirmation of that. So what does that mean? It means it will continue. We do expect the strength in U.S. employment to continue, at least for the first half of the year until there's more clarity on some of the other policies that come through. But it's a good thing for the economy, which is not necessarily a good thing for bonds.
or stocks. I don't think you're not stocks are outside your expertise. Is that fair to say?
That is fair to say, but we do trade high yield. Okay. We do trade investment grade. So we do see high yield as the equivalent of stocks, what we call a risk asset. So you are seeing those spreads widen. We think overall there is opportunity coming about this year to go long risk assets and high yield bonds. Yes.
So what does this mean to the Fed then? You seem to be sketching out a scenario where investors should be aware of or concerned about the Fed becoming less aggressive in reducing rates, correct?
Yes, and what we actually look at, there's two things we look at in the employment number. One is the unemployment rate and the other is wage inflation. So the unemployment rate in the US right now is 4.1%. We believe between 4 and 4.5%, the Fed is neutral. If that unemployment rate ticks above 4.5%, they're back in an easing stance. If it goes below 4%, we're actually in a hiking stance. So we're getting closer to that 4%, so we're watching that closely.
So just let's circle back to that, because that is something that everybody would be interested in. What would it take for the U.S. Fed to actually take a decision to raise rates?
I believe it's two things. One, it's the unemployment rate going back with a 3 handle or 3.9 or 3.8, so below 4%. That's one. The other one, and that reflects the number we're looking at as well, is wage inflation. Wage inflation in the U.S. was steady on this one in regards to the expectations. I believe it was 3.9 or around there, which is a good number from a Fed perspective. If that starts ticking up towards 4.5% and 5% again, that is what the Fed's looking at. An important number from a wage inflation perspective is the ECI number that comes out quarterly in the U.S. So keep a close eye on that going forward as well.
Okay. Your take on the Canadian numbers, which are also stronger than expected. And for the first time in a while, the increase to the Canadian population was outstripped by the actual number of jobs added to the economy.
Yes, and we still believe the Bank of Canada is in easing mode and will ease further this year. So what are the signs that we're looking at in Canada? Almost the exact same as the U.S. Where we said in the U.S., we look at the unemployment rate to be between 4 and 4.5, above 4.5, they ease, below 4, they hike. In Canada, that number is basically 6 and 6.5. They're still in easing mode as long as we're above 6%. They accelerate or on hold or in an easing territory above 6%. We're still or above 6.5, sorry. We're still at 6.7. And they're on hold in between 6 and 6.5. So our bias is definitely towards more easing in Canada as compared to the U.S.
So this sounds like the potential for the differential between rates in Canada and the U.S. to widen out.
Yes, so it's very interesting. When you showed the Canadian dollar chart and your previous guest said that's a dollar story or a U.S. dollar strength story, I agree with that. What we're watching out for on our side is there's two things that are driving the Canadian dollar. One is U.S. dollar general strength, that is the tide, but interest rate differentials as well too. So yes, that interest rate differential widening, which means Canadian interest rates lower than U.S., bodes for further weakness in the Canadian dollar.
What kind of corner is the Bank of Canada pushed into here?
They're not pushed into any corner. They don't mind a weaker dollar. That's part of the implication of easing in regards to differentials. The reason why they don't mind an easing dollar is probably the exact reason why we're seeing these strong numbers. It helps employment. Because our goods become more competitive from an export perspective, there's more orders come in, it helps employment, and you need better employment when you have the mortgage rollovers coming and all that, because you need people to be able to pay the mortgages.
Yeah.
So they're in a very good spot. They're actually in a spot where they could be patient. They're seeing good numbers where our inflation hasn't ticked up or isn't as sticky as the U.S. It's still an uncertainty with tariffs when that comes in. But nonetheless, they're in a good spot to wait and see. So we don't believe they'll do anything the next meeting, but they still have an easing bias.
What's your take on the theory that a lower Canadian dollar causes the importation of inflation, that goods purchased in the U.S. become more expensive?
So I'm always about context. So as a standalone statement, that is very true. Our costs will increase in regards to, the U.S. dollar component that when we import goods or manufacturers, that will be passed through to consumers without a doubt. So on a standalone basis, that is true. Having said that, from a Canadian individual, if the U.S. economy is doing better and we're getting a little bit of inflation, I would prefer that scenario because it means the Canadian economy would do better because they're such a large trading partner.
Earl, thank